A lot of people believe that investing in stocks is reserved for the super wealthy. We often look at investor guru Warren Buffett and other big shots and conclude that they have the money to invest. Well, you may be wrong. Whilst it is true that the bigger you invest, the bigger you stand to gain or lose, you can as well start with your little money and grow it. Don't let anybody fool you into believing that you need $5 million before you can make money from the stock market. My guess is that if you are watching this video, then you have a budget of say $500 or less. Today, I'll be breaking down the best way to invest on Robinhood with a budget of $500. But first, let's dish out some sound investment tips. What makes a smart portfolio? Personally, I think the idea behind investing is to grow enough wealth to outpace the rate of inflation. Generally speaking, we all want to make enough money, maintain good credit ratings, live debt-free, and be able to purchase that Lambo. It's therefore natural to seek investment offerings with the greatest growth opportunities. But here's the thing. The greater the income and growth potential of an investment, the greater the risk you incur. Sound investment requires having a balanced risk-to-reward ratio. And frankly, this can be hard to achieve with just $500. Just to put some perspective to this, Apple stock currently costs around $450 per share. That means your $500 budget can only purchase one Apple stock. While I am a total sucker for investing in already established companies and brands, things can go south really quickly. Your $500 could drop to $200 before you know it. Putting your entire $500 in a single stock is not a smart investment decision. This is my personal opinion though, and I'm not a financial expert, so don't take my word for it. If you feel comfortable with investing all your money in a company stock like McDonald's, Facebook, Apple, or Twitter, please feel free to do so. All of these stocks mentioned above are less than $500. What I think you should do instead is to shoot for a more rounded portfolio. This is why I recommend that you initially invest your $500 in mutual funds or exchange-traded funds, ETFs. Traditional mutual funds and ETFs are both basically pools of money in which investors buy shares. While mutual funds are usually actively managed to buy or sell assets, ETFs are mostly passively managed, since they typically track a specific market index. ETFs can be bought and sold just like stocks. Another difference between mutual funds and ETFs is that mutual funds tend to have higher fees and expense ratios than ETFs, thus in part reflecting the fact that they are actively managed. Depending on the type of fund and company, mutual funds can cost up to $500. The Vanguard 500 Index Investor Fund, for example, requires a $3,000 minimum investment. Meanwhile, the Growth Fund of America, offered by American Funds, costs an initial deposit of just $250. With that said, it is obvious that ETFs are your best bet if you have a strict budget of $500. ETFs are funds that you buy into that are usually electronically managed. In simple terms, these are funds that take a bunch of stocks and shove them into one package. Now obviously, this is good if you don't have a lot of money because you are able to make your money go a little farther. Take the Apple stock for example. Instead of tying your entire investment to the performance of Apple, you can achieve diversification by investing $500 in an exchange-traded fund. It's also worth adding that Robinhood has a feature called fractional share, which allows you to buy a fraction of a share. Fractional share on the platform can be as small as a millionth of a share, rounded to the nearest penny, or just $1 of any stock. So, sign up to Robinhood to start your investment journey if you don't already have an account. This is not a sponsored post. Business Ideas 365 is not making any money from Robinhood for this video. With that out of the way, a smart portfolio is a well-rounded portfolio. And whether you choose to follow your gut in buying the share of just one company, or decide to play it safe through an ETF, remember that the ultimate goal is to make money. Going with the crowd. As much as I'd love to tell you what stocks and ETFs to invest in, I can't. The market is quite dynamic and it is important that you conduct your own research and make your own investment decision. From my experience in the stock and blockchain industries, I've noticed that a lot of new investors tend to follow the crowd. The stock market is filled with a lot of speculations. Although it is possible to make some profit speculating the direction of a stock, your surest bet will be to base your decisions on sound research. Looking at Robinhood, it's obvious that its users are big fans of thematic ETFs. The most popular ETF on the platform is currently the United States Oil Fund LP, USO, which has over 170,000 shareholders, and the reason for this growth is quite obvious. While the global coronavirus pandemic has taken its toll on oil prices, investors are looking to position themselves for an eventual rebound. And this has poured into USO, with billions of new investment cash entering the fund. Interestingly, oil is not the only area investors are speculating about. The aviation industry has also been badly hit by COVID-19, with some countries placing a ban on domestic and international flights. Investors are also looking to play with airline stock. To this effect, more than 32,000 Robinhood users have bought the US Global Jets ETF, JETS. Other fan-favorite sectors include gold and cannabis. Sometimes going with the crowd is the right decision. At other times, it may be best to consider other options. The stock market is largely irrational, and people make decisions based on emotions instead of logic. Now, these are the 3 common pitfalls you should avoid as you invest. Number 1. Assuming ETFs are always fairly priced. The fact that ETFs are a combination of several stocks does not automatically mean that they give you the best bang for your buck. Don't assume that ETFs are always fairly priced throughout the trading day. Although ETFs have a net asset value (NAV) based on the aggregated value of all the assets they hold, market prices can deviate from their NAVs and trade at either significant discounts or premiums. For this reason, it's possible to buy into an ETF at a premium and then sell at a discount. More liquid ETFs generally don't trade at significant discounts or premiums. Number 2. Going with the most popular ETF in a category. As a new investor, don't make your decision based on a brand name without considering all the key aspects of investing. Here's a shocker. In 2017, more than 130 ETFs were shut down, including those managed by providers like State Street SPDR and PIMCO. An ETF shutting down does not mean you will lose your investment or that your shares become worthless. What it means is that your shares typically will now be worth the amount to the underlying value of the investment that the ETF owns. Other downsides include a possible termination fee, delays in receiving your money after liquidation, and capital gains tax if you operate taxable accounts. The crowd is not always right, and you must learn to recognize the signs of an ETF that is vulnerable. Some of the makers include a small amount of assets, usually less than $50 million, a short track record of less than 2 years, and low liquidity. Number 3. Assuming that all ETFs will yield similar results. Although Robinhood has tried to simplify how investments are done, you still need to do some work. ETFs in the same category will often not yield the same results. As a matter of fact, in most cases, they will provide different levels of risk and performance depending on a number of factors. For example, there are a number of ETFs to choose from in the tech sector. The Technology Select Sector SPDR Fund (XLR) and the Vanguard Information Technology ETF (VGT) has a lot of assets in their portfolio and may seem interchangeable. However, while SPDR Fund tracks 72 tech stocks in the Standard and Poor's 500 index, the Vanguard Fund follows a more diversified MSCI index with more than 340 stocks. SPDR Fund also invests 60% of its fund's assets in its 10 largest holdings, while Vanguard puts in just 53%. As you can see, these are similar ETFs in the same sector, but with different approaches. The result is that the SPDR Fund is more likely to outperform when tech giants like Microsoft, Apple, and Facebook dominate. On the flip side, Vanguard's strategy to keep about 15% of its overall portfolio in smaller companies has produced better performance. So, it's important to look at the long-term performance of various ETFs that appear to have a similar focus. To wrap this all up, investing $500 in Robinhood won't make you an overnight millionaire, far from it. You will be lucky to even double or triple your investment in 2 years. Your plan should be to slowly grow your wealth. You are not a day trader, so don't bother about daily price fluctuations. Keeping your investment in the market long-term is the best way to ensure your returns.